So I'm going to Drexel to start as an AP position in the fall. And this work is titled Liquidity Misallocation on Decentralized Exchanges. Let me start with some motivation. The liquidity is pretty important, and DeFi included. And then a primitive form of liquidity is how easy it is to exchange one asset into another. For example, I have some Bitcoins. I want to convert that into US dollars for some other uses. I want to do that quickly. This is the type of liquidity I'm going to focus on in this paper. And then in the DeFi system, well, in the blockchain space, decentralized exchanges are the ones that aim to provide this type of liquidity while being fully decentralized. I'll be more precise with what I mean by decentralization, but let me just give you an idea of why they're important and how fast they've grown. The trading volume on these decentralized exchanges have grown from less than $1 billion in the beginning of 2020 to over $100 billion by the end of 2021. And again, I think the key here is that not only are they big and they're growing, the fact that the important part is they work very differently from the traditional exchanges. And I'll be more precise about that too. So in this paper, I'll tackle this specific question. Who supplies liquidity on decentralized exchanges, and is it efficiently allocated? So like who supplies it, and are they doing it in a sort of efficient manner? And here are the findings. So what I find is that liquidity providers on decentralized exchanges behave quite naively. They chase the part of the return that is marketed and ignore the part that is implicit. And I'll get to more details when I get there. And as a result of this, there's significant misallocation of liquidity across asset pairs, across pools. And when I say misallocation, and the way that I'm showing it is that there's abnormal returns in the cross-section of pools. And this abnormal return is very persistent and predictable. So think about return predictability in your asset pricing classes. I'm going to interpret that as misallocation. And I'll show supportive evidence of that. This is not about risk, but rather, this is a form of abnormal return. And lastly, if I have time, I'll show that liquidity would have been a lot lower on aggregate on the Uniswap network if the liquidity providers were sophisticated. In terms of contributions, I'll be brief here. I contribute to the topics of capital misallocation, and then since a lot of the liquidity providers I'll show, they're pretty unsophisticated and they seem to be essentially these retail investors. I'll talk about my work is related to retail investor mistakes. And in that spirit, this is also related to the effect of financial innovation. So I will actually talk about both the bright side and the dark side of financial innovation in this context. And here the innovation is these DeFi applications. And then more specifically, I'll focus on these automated market makers, and there's growing interest in this. So let me start with some background. The starting point is going to be, let's start with the traditional stuff first, right? Let's start with the traditional exchanges, and then we can understand what are decentralized exchanges and how are they different. So the traditional exchanges, think about like the New York Stock Exchange for stocks, or as we all know it now, FTX for cryptocurrencies. And the hallmark of these traditional exchanges is that there's a centralized entity that is responsible for intermediating the transactions. And when this happens, there are a couple of potential drawbacks, potential problems. Think of so FTX, as we all know it, what happened was, this centralized entity essentially misappropriated customers' funds. So there were fraud in this case. And another drawback that is maybe a little less popularly known is they can basically implement any trading halt at any point that they seem beneficial to them. So during the Terra Luna crash and during the recent USDC crash, essentially there were halts of trading of Luna and USDC, almost all the centralized exchanges. And part of the reason is because, and this is anecdotal, and they're not gonna really publicize this, but I think they have some stakes. These exchanges have some stakes in this assets themselves. So they want to exchange these assets themselves first before the customers, or they don't want to be in a bad position because of customer withdrawals. And last but not least, let me just highlight that for these centralized exchanges, there's also sort of a lack of privacy because regulations. There's know your customer policies. You have to disclose who you are, give them your ID to these exchanges. So how these traditional exchanges works is usually these sort of limit order book. And the way it works is sophisticated liquidity providers, think about like high frequency traders, they basically maintain this buy and sell orders at a very high frequency. So they post both the bid orders and the buy orders, and then they will shift the orders in response to order flows, right? They do this as a very high frequency, which is also in itself is sort of a problem that many people think needs to be addressed. So too much high frequency trading that is potentially not very beneficial or welfare improving in the sort of the social planner point of view. Too much sort of this arms race in the high frequency trading space. So that's why we have these decentralized exchanges. So in these decentralized exchanges, the transactions are intermediated not by a centralized party, but by smart contracts. And the benefit, or hopefully the good things about this is that it can be trustless and then anonymous. So you don't have to trust anyone. For example, during the recent trading halt in response to the USDC withdrawal, you could basically see that the centralized exchanges trading of USDC was frozen, but there were a lot of trading activities of USDC on decentralized exchanges. So this is a benefit. So that's a benefit, but there's a drawback. What is the drawback? Well, high frequency trading is essentially not very viable because sort of like the technical reasons right now on Ethereum. The gas price is very high and each transaction takes a long time and then it costs a lot of money, a lot of gas money. So I was talking to Nir a little bit about this earlier. So I think, these layer 2 solutions are potentially going to change that. So basically alleviate this sort of problems in the future, hopefully. But right now that's the case. So you can't do limit order book because high frequency trading is essentially impossible. And as a result, there's very few people posting bids and asks because they just sit there for a long time without being hit. Think about the corporate bond market, which is similarly very illiquid. And that's why these limit order book system doesn't really work there. So what's the solution? And actually, this solution has been sort of proposed for corporate bond market as well recently. So people came up with these automated market makers, so the so-called AMMs. I'll get into the details, but I want to say that I'm going to focus on a specific form of AMM that is popular so far, at least. It's called the constant product AMM, the constant product automated market maker. So let me talk a little about like how they work. I'll be brief because I'm assuming that people here are pretty familiar with them. So how it works is that like each pair of assets forms a pool. So think about Bitcoin and US dollars. They form a pool, and the swap between this pair of assets follows a constant product curve. So in this graph, the x-axis, think about Bitcoin. So x is the number of Bitcoins there. Y is US dollars. Y is the number of US dollars in that pool. And essentially, the number of x, the number of Bitcoins times the number of US dollars has to equal to this constant K. So everything has to sit on this curve. So think about at the beginning of the period, there's x0 amount of Bitcoin and y0 amount of US dollars. If you swap in delta x amount of Bitcoin, what you get out is this delta y, so that you can still stay on the curve. So you basically move to this x1, y1 point. So there are a couple of interesting properties with this design, sort of like why it works. It seems very sort of simple and Yeah, it seems very simple, but here are a few sort of like nice properties it actually gets. So the first one is like the bigger the trade, the worse the term. So think about like if you exchange bigger and bigger amount of delta X in. So here you see that you can double the amount or triple the amount. The amount of US dollar you swap out actually do not go double or triple. It actually like there's less and less incremental US dollar you're swapping out. So that's like one of the nice property it has. The bigger that you trade, the worse terms that you get, right? And then the other important thing that we typically care about is like how does price discovery and updating works in this decentralized in this exchange. So price, which is just the derivative of one asset, like the how much does the number of US dollars you get for a small number of for a small number of Bitcoin you get. So this is definition of price, right? So it's just derivative. You can show that basically with that constant product function that you have, it's just a ratio of the two tokens. So it's like you can derive this pretty easily. And as a result of this, you can also see that like price is pinned down by the amount of trades that needs to happen. So you can view it in two ways. So first of all, like if you swap in this much of delta X, the price, which is again the derivative, changes from P0 to P1. And the more you sort of swap in, the worse the price gets. And also the flip side of this is if you give me a price, so you say like, oh, the price needs to happen at P2. So for example, on the other exchanges, there's the price at P2 right now, and you can do cross exchange arbitrage. You can see, okay, how much trading is needed for the new price to reflect it. You can basically derive this, right? You can see that, okay, where is this P2 gonna be? So where is the delta X, delta Y is gonna be so that P2 is what it is. Okay, so now let's get to the interesting and important part, which is like really what this paper is about, which is liquidity provision on CPAMM. So on these CPAMM liquidity providers deposit and withdraw both assets in equal value. Why in equal value is just because this way the pool price doesn't really change. So I can prove this pretty easily with and show you the math. I'm just gonna skip it here. So liquidity provision is very easy here. There's no price. You don't need to specify price anywhere. You just need to specify, okay, I want to deposit this much Bitcoin in US dollars as a liquidity provider. I don't know what's going on, but this is how much I'm supplying the liquidity. Let me just show you the liquidity provision in the sort of the user interface of this. So this is Uniswap v2. So you basically say, okay, I'm going to put in this much Ethereum, this much whatever this token is, and then that's it, which is a lot easier than say on the limit order book where you need to supply both the price and the quantity. And I think I forgot to put it here. It also means that the liquidity provision is very passive. And I'll show you that it's actually very passive. They just put the money there. You don't need to update it. It gets traded. But you do this in a very passive and easy manner.
I have a question.
Yep.
So this paper you focus on version 2, right?
I focus on version 2, yeah.
Okay.
Yeah, so V3 is an interesting topic. So when we get there, I'll talk about why analyzing V3 is difficult. I am going to do that. It's on my to-do list, but you will see when we get there, it's easy to do the type of analysis I'm doing here for V3. Okay, so let me talk about the, like this is how you provide liquidity, but why would you do it? Right? Like why would I do this thing? Well, it's because you get benefits. You earn this fee revenue as a fixed percentage of each trade. Think about like people trading your Bitcoin for US dollars or vice versa. Each time they trade, they need to pay you a 30 basis point fee. One thing to note is that this fee is shared by all the liquidity providers of this pool. So there's this decreasing returns to scale mechanically built in. So the bigger the pool for the same amount of trading and the fees, it's earned by more liquidity providers. So the bigger the pool, the less the return that I get. So that's a good side. So that's the pros. What are the cons? The cons is that you incur adverse selection losses. So this is, excuse me. So this is not very unusual, but let me just talk about how that works in this setting. So when price go up, for example, when the price of Bitcoin go up, remember how price updates in these liquidity pools is that there has to be trade. So price is still at the original point. So you basically have to sell your Bitcoin as a artificially, not artificial, at a stale low price. And that is how you lose on this. And this is also in the industry, people call this impermanent loss. And the reason is because if its price doesn't change, if it goes up and then goes back down, you essentially have no loss. But the fact that it's impermanent really sort of like assumes that price reverts, but doesn't really happen. So let me just illustrate further what adverse selection loss is. So think about, so here's a Bitcoin and USD pool. Think about there's like one Bitcoin and the price of Bitcoin is $10,000 right now. So there has to be $10,000 in the pool. So for them to be equal value, right? So that's the initial starting point. So we have the K, which is the product's 10,000, and the price, again, it's the ratio of the two tokens, 10,000. Now think about like the price of Bitcoins go up by 400%. So it goes from $10,000 to $40,000. I think this was during 2021. So K needs to stay constant, right? This is the rule. So it has to stay at $10,000, but now price has to go to 40,000. So you can basically derive what the X prime and Y prime needs to be. And I've derived it for you here is 0.5 and 20,000. So this is a new price. And so if you supply the liquidity in first, and this is what you get out. So let's compare so when we calculate impermanent loss and think about like the returns to liquidity providers, we basically compare this with, for example, if you didn't supply liquidity at all, what's the counterfactual, like the opportunity returns you will get. So you have one Bitcoin, it goes up to 40,000, right? And you have your original $10,000, so you have $50,000. But now since you supply liquidity and you only have 0.5 Bitcoin and $20,000 now, your value goes to 40,000. And this difference is the adverse selection loss or the impermanent loss. And it's at 50% of the original positions, right? And one thing further that I want to note is that just because of the functional form of this setting, you can actually derive adverse selection loss as a function of price. So I will spare you with the math, but basically adverse selection loss is a function of how much price changes. And I can plot this function here. So the x-axis is how much price is relative to the original price. 1 is the original price and 0 is 100% loss, and then 3 is 200% return. You see the adverse selection loss goes up whenever price go up or down. It is 0 if price stays the same. Okay, so I just wanted to make sure that everyone has those background in mind. And I want to highlight, what is different this time with decentralized exchanges. What is not different is that we still need liquidity providers. It's not like you want to exchange one asset for another. You still need people who supply liquidity in the first place in order for you to do that. The difference this time is there's passive liquidity. So there's not like high frequency traders that pose these bids and asks. And then as well show you, I think a lot of these participants are retail investors that are not very sophisticated. And then not different this time also is that liquidity provision are gonna face asymmetric information, when price changes, and then these adverse selection losses. What is different this time is that this adverse selection risk is deterministic with respect to price. So as I just showed you, it's a function of price. And then it's sort of a nice property. I'll show you that this this allows for the fact that we can option price adverse selection. So let me get into the results. Oh, before that, let me just briefly mention my data. I'll focus on Uniswap V2. And from its launch in 2020 to 2021 when V3 was launched. I'm going to focus on the largest pools just to get rid of some of the noise. And then I'm going to have a cutoff at May 2021. I will show you results after May 2021, but the interpretation is going to be slightly different, and I'll tell you why. Prices are from Yahoo, and then implied volatility is from this provider. So I'm doing fine on time. So the first thing I want to show you is what are the liquidity returns. And basically I'll show you there's sort of these abnormal returns in the cross section that I interpret as misallocation of capital. But first of all, I think let me start with the sort of like the question of like what should be the LP returns in an efficient market. Well, in an efficient market, LPs should earn zero risk-adjusted returns, accounting for risk for sure, on net. And remember that the LPs have fee revenues and adverse selection losses. This is the two components, the pros and cons of the liquidity provision. So, but we should focus on the net of this too, right? And what happens when there's positive net return? Well, like if there's very positive risk-adjusted return, then there should be more inflow into this pool, right? This should be a sort of like attractive to people. So there should be inflow of liquidity, and fee revenue per LP, this should go down. Sorry, this should be a down arrow. So because more people are sharing the same revenue, basically. So net return should go down. Okay. Empirically, I'm going to show that these LP return is persistently different from zero for many asset pairs. And one important thing is to account for risk. So let me first just show you the returns across pools. So what these graphs shows you is the distribution of average returns. So each observation is one pool. So in the cross section. And the left shows you the average return. The right shows you the alpha with respect to this three-factor model. So there's like market and then momentum and then small minus big kind of factors. So take out some of the risk factors that you can think of. What this shows you is that there's very high and very low average returns across pools. Some pools are earning more than 50%. So this is annualized weekly. So annualized return of more than 50% per year. Some are earning more than negative 50%. And the risk adjustment doesn't really change this picture that much.
Can I ask a question?
Yep.
So this is the net return, or it's just a fee?
Yeah, this is the net return.
Okay, and then so I guess because impermanent loss is really sensitive to when do you measure the time change, right?
Yeah.
And then would that change if we measure let's say monthly or bi-weekly or something like that?
Yeah. Let me see. I did not have the monthly stuff. That's a great question. Monthly return. Yeah, so this is weekly. So I'm measuring impermanent losses on a weekly basis. I think so. I think I think where you come from is let's look at longer horizon. Maybe that's a sort of the horizon that these liquidity providers focus on anyway. And then the impermanent loss is actually not that big because price reverts. So it's actually not bad. So in this paper, I'll actually focus on the weekly horizon, which I think is still pretty long. And then what I will actually show you later is that over longer horizons, both LPs seems to correct these misallocations, and but I cannot distinguish between maybe like it's also impermanent losses reverts. I'll show you that over longer horizons, it's not that inefficient. So I'll focus on this sort of like if you think I'm okay with you interpreting all my results as sort of like a short-term misallocation. Okay, so this is just average returns. So what I will show you next is that these abnormal returns are indeed very persistent. Again, over a weekly horizon. Persistent over a weekly horizon. So what I'm going to do is I'm going to use a sorted portfolio approach. Look at the representative set of pools. And at the beginning of each week, I'm going to sort pools into quintiles based on their past returns. And then form a portfolio for each quintile and hold the portfolio and see what happens to each quintile of based on past returns. And here are the results. So what this shows is that let's look at the first column first. So if you have bad past returns in the past, so you're the low quintile, your future net return is gonna continue to be low, very negative. And vice versa, if you have high past returns in the past week, your future net returns over the next week is going to be very high. If you calculate the difference between the low past return pool and the high past return pool, the difference is 1% per week. And accounting for, so you can regress this on the three-factor model. The three risk factors doesn't really change this as much. So this is outdated. This should be 1.06% per week. If you annualize it, it's more than 50%, I think. So pretty big sort of return differences across pools. So you can think of this as a trading strategy, but I don't want to push on this too far, just because technically it's not obvious to me how you can short liquidity pools. So the point here is just to show you that these pools have very different returns, and then some sort of sorting can allow you to distinguish the returns in a very dramatic way. And I think this is a sign of misallocation. So some pools, even though they have high past returns, they continue to have high past return in the future over the next week. Let me briefly, so remember, net return is just the difference between fee return and the average selection losses, right? So I can actually look at these individually. So the last two columns are the previous results. The left two break this down. And you already sort of see where I'm going with this story. You see that like the low past net return pools, they actually have pretty high fee returns. But the problem is that they have huge average selection losses. So if you subtract the two, they have negative stuff. So this is just something to have in mind, and it will, basically I'll spend a lot of time talking about why this happens. Okay, so the last part of this section, so what I did is I regress on this three-factor model to account for risk. But maybe you're not convinced by that. Maybe we just don't have like good risk factors right now, right? So what do? So I'm going to leverage the fact that, like, remember these average selection losses is a function of price. So I can actually option price the average selection loss. So I'm going to use the implied volatilities from from this provider, which basically tells me what is the risk neutral or like risk included volatility based on options. And we can option price average selection loss, or another way to understand it is that we can basically mimic the average selection losses with a bundle of options. And I'm going to show you what is the return from selling options that mimic those average selection risks. So that is sort of like, if you don't want to supply if you don't want to supply liquidity on Uniswap, this basket of options is going to mimic exactly what you would have got, but with the compensation there from the options. And here are the results. So the red line shows you the realized fee revenues. So this is if you supplied liquidity to the ETH USD pool. Okay. And there's some technicalities here. I have to average the different US stablecoins pools here. But this is the average return across the ETH US dollar pools. It's pretty high. And the black line shows you the options implied liquidity compensation. It should say compensation here. Sorry. So this is basically if you want to mimic your adverse selection losses, so you have exactly the same exposure to adverse selection losses, but these are the option revenues you would have got if you trade options instead of supplying liquidity. And you see a gigantic gap throughout this time that V2 is active. So the first time they're over certain threshold and until V3 loss. And it's almost always that supplying liquidity is better than selling options. You see that sort of goes away after V3 launch, and I'll talk about why. But this gap is what I want to say that there's another sign for misallocation. So this is another sign for that there's abnormal return. And similar story for Bitcoin, if you restrict to the window where the pool is sufficiently big and before the V3 launch, you see that red line is always above a black line. Okay, so why are net returns predictable?
What with stablecoins? Stablecoins is there is no gap?
Stable coins, you mean like stable coins pairs?
Yeah.
So I don't think there is good options data on that. If there is, please let me know. But I don't think so. The Bitcoin US dollar, basically the Bitcoin options is pretty deep. The ETH options are fine. The last time I looked at it, I forgot the exact number. But if you go to the smaller tokens or even stable coins, I think the options become
nothing. Okay, yeah.
Okay, not very trustworthy, the data. Yeah, so okay, so hopefully I've convinced you that there's abnormal returns, but why? In theory, LPs are incentivized to equalize returns across pools, right? So if there's some very high positive net return on some pools, as I just showed you on these Bitcoin pools, liquidity should go up, fee revenues should go down, so this go down, per person should go down, and the net return should go down. Empirically, what I find is that LPs do not really respond to net returns. Instead, they respond to part of the return, the fees, which are heavily marketed, and they just ignore the adverse selection losses. Let me just try to convince you just anecdotally. So if you go to Uniswap's website, I'm not sure if this is the most updated one, but this is the one that I took a screenshot 1 year ago. You only see fee revenue. There's no mentioning of adverse selection losses at all. So on the last column here, so what these are is, so this is the size of the liquidity pool. So these are different pools, and the size of the liquidity pool, the volume over the last 24 hours, the volume over the last 7 days, and then the fees are basically a fixed percentage of that, right? So it's just a 30 basis point of that. And then what they calculate is the fee revenue, which is the ratio of the fees as the size of the pools. And you see that is these crazy numbers, 70%. It's always positive by definition, all right? And it's very high. And nowhere it mentions adverse selection losses, even though I think it's pretty easy to calculate. Okay, so let me empirically show you that this LPs don't really care about that. So I'm going to look at a sample of V2 pools and run the following regression where I'm going to look at the flows in and out of these liquidity pools, see how they respond to fee revenue, adverse selection losses, and then add controls. The controls include past flows, pool size, and an indicator of whether there was any airdrop or not, which is very important for the flows. And here are the results. The first column, I'm not going to break this down. I'm going to just regress flows on net returns. So look at how flows are in response to past net returns. And the response is close to zero and not significant. So this is what I meant when I said the LP seems to just don't really respond to net returns. So even if some pools have very high net returns, they don't really respond to that. And the last two columns break the net return down into fee revenue and adverse selection loss. And you see that they respond to fee revenues highly. So a 1 percentage point increase in the past fee revenue. So what people really usually call this the APY, like 1 percentage point increase in the APY leads to 3 percentage point increase in flows over the next week. I think this is very big. And you can see this from the mean of the pool, the flows, which is only 2.5%. And then you can, yeah, this is pretty big. Average selection losses, on the other hand, it's not very significant. And much smaller. I think that's the more important thing. It's even if it's significant, it seems to matter a lot less. So I actually have very robust results for this. I can look at various specifications, various frequencies. I think one thing that Kite probably was interested in is if I look at these flows over a monthly frequency, what happens? Oh, is this the monthly thing? No, it's not the monthly thing. Sorry. So if I look at like monthly flows, what's interesting is it seems to like not very predicted by anything. So they still respond to past fee revenue over the past month, but it's significant. And my interpretation is that over a monthly horizon, if you expand the horizon, you know, it becomes the market becomes more efficient. You know, like the flows sort of correct themselves, and then you don't really observe any sort of like wrong behavior or abnormal behavior. Okay, so that was that. So hopefully, you know, I'm more than happy to show you robustness results on that. But let me push on and say, you know, like you can say that like, oh, maybe chasing fee is like the right thing to do, right? Like maybe it's fine. I'm going to show you that like chasing past fee is not good. So what this graph shows you is the same sort of the portfolio approach as before, but instead of sort on past net return, I'm going to sort on the fee return. And what you can see is I can calculate the future net returns based on past fee returns. There's no explanatory power by that. I can break this down. Well, let's first look at the fee revenue part, right? Like the net return is always there's the fee revenue and the average selection losses. Let's look at the fee revenues. So the first column shows you the past fee revenue. This is a sorting variable. Okay, it goes up monotonically, sort of by design. What you see over the next period is that these fees sort of revert. So the low fee pools, their fees grow a lot. The high fee pools, their fees decrease a lot. So there's sort of this normalization going on, which is reasonable if you think, you know, these things are temporary and then are not very persistent. And on the other hand, the amount of liquidity, so if you think of the fees as a numerator and the size of liquidity is a denominator, the denominator grows a lot for these high fee pools, sort of expected as what I showed you earlier, because these people chase past fees. So there's sort of like a double whammy effect, right? So like your numerator goes down, your denominator goes up, and as a result, the future fee revenue, the spread is a lot lower than before. There's still some spread, so you can even argue that maybe the liquidity providers are not like chasing it. Well, anyway, sorry, let's not go there. It basically says that like the future fee revenues, it sort of, instead of being still very spread out, it averages out a lot more. And more importantly, so that was a fee revenue. Let's look at future average selection losses. It sort of strongly correlates with the fees. And the reason, because when there's like a lot of fee revenue, so a lot of trading for an asset, there tend to be a lot more information going into that pair of token, or like a lot of sentiment trading, right? A lot of people are like moving money, like a Bitcoin is going up and up. It's not reverting. And that's why their average selection losses are also very high. And when you average this two, when you subtract one from the other, you get insignificant net returns. And on the other hand, I think this graph is a little bit outdated. The actual number is a little outdated. But the point is that if you do a double sort, both on fee revenue and average selection loss. So on the x-axis, I'm sorting by the past fee, but for each of the quintile of fees, I further sort this by adverse selection losses. You do obtain a very significant net return. So you sort of have to take it. So basically, the point is adverse selection losses give you a lot more returns as a liquidity providers. You should care about it. So within the last 5 minutes that I have, let me show you very briefly what happens after the launch of V3. So again, this is not analyzed. This is not analysis of V3. This is still analysis of V2, but I want to show you what happens after the V3 launch. So what I find is that what I show you here is this is the return persistence or the return predictability analysis. So sort the pools by past net returns and look at their future returns. This return predictability diminishes. So there's still a difference between the high minus low pool, but the return differences is a lot smaller. Actually, I think I calculate this on the monthly frequency, which is not correct. It should be the weekly frequency. But if you trust me, what I aim to show is just that the return predictability sort of diminishes after V3 is launched. And then you can also sort of look at how LPs behave. So what I do here is that I'm going to run this Fama-Macbeth regression where I regress flows on past fee and the average selection losses for each cross-section. So at each point in time, I'm going to run this. And you see that in the beginning of this thing, there's a lot of responsiveness to fee revenue. Average selection losses maybe like close to 0. But this sort of diminishes over time. So after the launch of V3, there's basically insignificant sort of attention to both actually, which is actually not very good. I feel like in my mind, if I'm a rational LP, what I would have expected is that both of them are very positive. Like I'm very sensitive to information both on past fee revenue and adverse selection losses, because there's some if the risk goes up, I should care about it more. But after the launch of V3, people just stop paying attention to any of them. So let me conclude.
But I can think about something. So if you think about the idea of being passive investor, that you put your money and you forget it for 10 years, which is, I think in that case, you're going to have kind of a selection bias because V2 is passive while V3 is more active. So if you're going to have V3 data, I think you will see that the V3 guys are more sophisticated, I guess.
Yeah. So again, this is not analysis of V3. So
I know, but I mean, this influence, it's create a selection bias between who use V2 and who use V3.
Yeah. You mean the liquidity providers?
Yeah, because if you want to be a V2 liquidity provider, it's really passive. If you want to be V3, with your restrictions about the price, so it's become less passive.
Yeah. Yeah, I mean, so I don't see how that affect this graph, but the problem with V3 is also so it's hard to sort of distinguish between who is active, who is passive. So you can have concentrated liquidity, but you're passive. So that's one thing. And also, so I talked to these Uniswap people a little bit, and what they find, I think it's probably true, that a lot of these V3 liquidity providers are also very passive. And they're passive in the sense that they both put it in for a long time, and then when they like, it's not very concentrated. They just say like, oh, I'm supplying liquidity. I'm going to take whatever the default range that you give me, which is pretty wide. So yeah, but like I can't do the analysis at the pool level just because the heterogeneity there. Like some people are very concentrated, someone is very wide. But yeah, like it is definitely on my agenda to say. So what I'm trying to do, I guess, is like do the analysis at the individual investor level, so that I can distinguish between if you are like exactly what is the type of liquidity you're supplying. But yeah, I mean, like think about the passive versus. I get your point that if I'm in it for the long run, I shouldn't care anyway. So maybe this is actually, the good thing. Like I just don't pay attention. I just put it in for a long time. I get it out after 1 or 2 years. I agree. Yeah, cool. So let me conclude. So DeFi is regaining momentum. A lot of theories are on these AMMs, but often assuming perfect rationality. I don't think these LPs are very rational, and I think it's pretty convincing that they chase one part of the return and ignore the other. And liquidity is as a result is misallocated across pools. Thank you very much.